Tapering is not shrinking the money supply. Tapering is expanding the money supply at a slower rate than you were expanding it before. They're not talking about stopping the debt monetization, going cold turkey, and they're certainly not talking about shrinking the money supply. They're simply talking about inflating the money supply at a somewhat lower pace than they're inflating it right now. But what this should really reveal to anybody who's got a brain is that they ain't going to taper. Because if they were serious about having to fight inflation, and if inflation all of a sudden picked up, they would not wait to warn the markets that they're going to taper in the future, because inflation might get worse between the warning and the time they actually start to do something about it. So to the extent that the data would suggest that inflation is not transitory or something else is happening and now it merits action, you have to act. You just can't delay the action because you want to warn the markets about what you're going to do. You need to do it. And in fact, they wouldn't just be talking about tapering. They would be talking about ending the QE program. Because if all you're willing to do is taper it, that's not going to be enough to actually deal with an inflation problem. Because you're still adding to the problem when you're expanding the balance sheet. Even if you're adding to the problem more slowly, you are still fueling the fire. Even if you're throwing on less fuel, you're still giving the fire more fuel, and it's going to get bigger. So they're not even talking about what would actually be required to the extent that inflation was too high. Because I think they recognize that there's no way the markets could handle something like that. So they're trying to give the markets a little bit of tightening, but not too much to really scare them. And in fact, I think that is why they even might have established this whole idea that we're not even thinking about raising rates, so they can start thinking about it and have the markets interpret that as some kind of tightening without actually raising rates. Because the one thing the Fed doesn't want to do is have rates go up, but it can't admit that it's never going to raise them. So it's trying to have its cake and eat it too, by tightening without actually tightening, and they do that by just talking about tightening, but not actually tightening. But the problem for the Fed is when they talk about tightening, the markets think they're serious. And so the markets start tightening for the Fed. Rates start rising in the private sector, which we're already seeing monetary conditions tighten because the markets still believe the Fed, right? It's like the Fed is this boy that cries wolf. And every time the Fed cries wolf, the villagers come running because they actually expect the wolf. They still don't realize that it doesn't matter how many times the Fed cries wolf. There's never going to be a wolf. So they can talk about, they can think about, they can do whatever they want about tapering and about raising rates, but they really can't do it. And of course, the greater problem is, and what people don't seem to recognize, is the longer the Fed waits to taper, the harder it actually is to taper. The longer they wait to raise rates, the more difficult it is to do it. So if they can't do those things now, how are they going to do them in the future when it's even harder? Because the longer they wait, the more debt we have. The more debt we have, the more vulnerable we are when rates go up, right? The more debt the government has, the bigger the national debt, the larger the Fed's balance sheet, the more the Treasury becomes dependent on the Fed to finance that debt. So if they can't taper now, how the hell are they going to do it in the future? If they can't raise rates now, how are they going to do it in the future? They can't. In fact, what's actually happening in the markets is the markets are now bracing for the wrong impact. They don't understand what's going to happen because just like the IMF chief economist is concerned, she said that because inflation is going to surprise the Fed by being higher than they thought or by not being transitory.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
She is warning that this could have a negative impact on the global economy because the Fed is then going to be raising interest rates much sooner than the markets expect. And she talked about how this would be bad, particularly for emerging markets, because it's going to cause the dollar to go up. It's going to put pressure on commodities. It's going to hurt the emerging markets. And so the recovery that we're seeing around the world is actually in jeopardy now because the Fed is going to be forced to admit it was wrong about inflation and start fighting it by raising rates. And that is what the markets are now pricing in. They're pricing in higher rates sooner, which is going to hurt the economy, reduce growth, which is why people are taking risk off, which is why stocks are under pressure, particularly the cyclical stocks. We're even seeing oil stocks have been coming down. We did get a pretty big reversal the other day after we took out that high and almost made a 7-year high in the price of oil. We've got some selling that has continued, but oil stocks really were selling off even before the price of oil reversed. Again, I don't think this is a change in the underlying trend for oil. I think oil prices are still moving higher. They're going to make new highs. They have not finished. This bull market is a long way from ending. But one of the reasons that these stocks are coming down in the sector is because people think the economy is going to be weaker as a result of the Fed having to fight inflation that it believed was transitory, but now that it happens to not be transitory, now the Fed has to start tightening. Well, the fact of the matter is, I don't even think the Fed ever believed inflation was transitory. I'm going to give them the benefit of the doubt that they're not that dumb. I think that they knew they had an inflation problem, but the bigger problem is that they can't do anything about it, and they're never going to admit that. So the easiest way to rationalize their policy of not caring about inflation and ignoring it was to pretend that it is transitory. So I don't think the Fed is going to be surprised when it turns out that it's not transitory. I think they already know that. And I think the reality is, if the Fed actually had the ability or the willingness to fight inflation, which is what the markets are now bracing for, which is what the IMF is now expecting, if the Fed actually was willing to do what it took to fight inflation, they would already be doing it. They would be fighting that battle right now before it gets even harder. Because again, the longer they wait to start the fight, the harder it is to win, because they let inflation get worse. They let the genie further out of the bottle. So the further the Fed falls behind the curve, the harder it's going to be to get ahead of the curve, which is what they need to do to put that genie back in the bottle. So what the markets don't understand, and I don't know when they're going to figure it out. I mean, maybe gold going up today, although it's not way up, but maybe it's starting to dawn on some people. It's not that inflation is going to turn out to be not transitory, and therefore the Fed is going to fight it. It's that inflation is not transitory and the Fed is not going to fight it. And because the Fed is not going to fight the non-transitory inflation, it's actually going to end up getting much worse than people think. And the reason that they're not going to fight inflation in the future is the same reason they're not fighting it now, because they can't do it without collapsing the economy. They can't do it without crashing the stock market, crashing the housing market, and forcing the U.S. government to dramatically cut spending or raise taxes on the middle class, two things that it is completely reluctant to do. So since the Federal Reserve wants no part of any bitter tasting medicine, even if ultimately it cures what ails us, they're not going to fight inflation in the future. They're not going to fight inflation now. They're never going to fight inflation.